Welcome to the Infinite Wealth Podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso. We just wrapped up our interview with Lamè Kinikini. Anthony, what's a takeaway or two you had?
I'm excited about this podcast.
I know you are.
Particularly, Cameron. I don't know if you know this, but I'm a recovering CPA.
I did not know that. Thank you.
One thing people would always come to me and I remember there's one friend of mine, Roger. He'll say, "Faso, what's some sneaky thing I could do to save money in taxes?" And I'm like, "Man, you are a W-2 employee. There isn't much. I mean, it's really very little you can do." And a lot of times people will get into real estate because there's some tax advantages, but unfortunately there's limits on using those losses against earned income. However, they call it the short-term rental loophole, but I don't know if it's really a loophole, but there is a way with short-term rentals that you can get advantage of the depreciation. And what our guest here did today really put together a way for you to get those tax advantages and earn some passive income in monthly installments. So I think it's a very interesting concept, particularly if you're in a higher income and you're a W-2 employee looking for ways to create some tax deductions. This is a podcast for you. Cam, what takeaway or two did you have?
I agree with what you said there. I would say that second part of the podcast, technical on some of the opportunities that he's talking about there. But I would reference the first part of it. The first part of it, he opens up, tells us his story. And one of the first things that he shared with us was that he was Tongan. And man, I went to college with some guys that are Tongan. And if you know them at all, man, these guys are tough. They are resilient and they are hardworking. And so I figured that he was going to be successful in this venture, but not only in this one, he's been successful in several of the ventures that he's done along the way. And again, I think that heritage also plays into just being a very good entrepreneur. Those characteristics are exactly what we need to be successful as entrepreneurs. So great takeaway, guys. We hope you enjoyed this interview with Lamè Kinikini. He is CEO and founder of Elk Ridge Investments, where they make real estate investing simple, scalable, and structured for cash flow. They identify the best properties, optimize properties, and streamline operations so you can build wealth through equity and maximize tax benefits without the complexity. Enjoy this episode.
Cameron, it pains me to interrupt you, okay? But we forgot one very important thing.
What did we forget?
That we are going to do a joint webinar where he can dive deeper into the numbers and you have that ability to ask questions.
Yeah.
And that is scheduled for July 28th. More information to come. And we will eventually get hopefully by the time we post this, we will have that link for you to register. But if not, let us know. This would be a great opportunity for you to learn more. And on that note, sorry, Cameron, or sorry, not sorry. Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso. And today we've got someone who's on the path that everyone said was right. Go to school, get a degree, get a nice job. But one conversation changed everything. Lamè, I cannot wait to hear more about this conversation, man. Welcome to the show.
Cameron, Anthony, appreciate you guys having me, man. I've followed your guys' podcast, and I'm just excited to have a seat at the table. So thanks for inviting me. So
we're excited to have you here, Lamè. Let's jump into it, man. Let's start right there with that conversation that kind of changed the path that you were going down.
Yeah, so it's funny. I think the context of this conversation probably starts a little earlier than people realize, just in my heritage, right? I'm second generation American. My dad was an American. He was the youngest of six, of a family that immigrated from the islands of Tonga. And so I don't know if you guys know where Tonga is. A lot of people know Samoa because they know The Rock. So The Rock is from Samoa. Tonga, just another sister island that's in the South Pacific. But that story is important because there's a lot of nuggets in my upbringing. My grandfather moved here from America. He worked over here by himself for 6 7 years until that was just for him to kind of build the American
Yeah.
dream to then bring his family over later, right? He brought the family over, brought my dad's older siblings over. My dad was the youngest of six. He was an American born baby he was born in Hawaii. And what's
Mhm.
interesting is my dad's name is Lyle Milton Kinikini. Lyle Milton is the name of the physician who delivered my dad because my grandfather had a vision and he was like, my youngest child, he's going to be a doctor one day. So he named him Lyle Milton after the physician that delivered him. You know,
Oh,
30, 40 years later, my dad then becomes the first Polynesian, full Tongan Polynesian to graduate from medical school from university here in America, right?
No way.
And so,
that's
yeah.
I'm
So,
thinking the pressure that is on that young man, to become a
oh,
doctor.
and that the context of that story is even deeper, right? Because my dad actually graduated from Brigham Young University, go Cougs, BYU baby. He graduated from BYU in an undergrad from social work, and as we all know, social work, they print money, not right. So he went to social work, realized he wanted more. He just was like, I feel like there's more. So he made a late life decision after he had my older sister, me and my brother. That's the children he had at the time. That's when he decided to go back and pursue medicine. So he went back to his undergrad, got the prereqs, got into medical school, went to residency, and did all this later in life, right? And my upbringing was because when he went back to school, I was like six, and so when he graduated residency from his medical school, I had just graduated high school, and so like my whole life was watching my
Mhm.
father
Wow.
hustle, right, grind, and I know it's education, but I saw a lot of entrepreneurial lessons in that lifestyle of just my dad having to navigate, student funds. He took out loans that you can't go back from, right? It's like, it's an all or none type of
Yeah,
thing, right? Board exams. He had to take his licensing exam. First licensing exam was 50 racks. We didn't have that. So he had to go raise money, right? There's just so many things in the journey of seeing my dad become one of the first Polynesians to do that path. To me, frankly, like there's a lot of entrepreneurial skills that served me well. So that's where a lot of this started. And when I started my path, I wanted to be a physician like my dad. I was a lot more intentional with that route. So by the time I was a junior, I had taken most of my prereqs, had a 3.8 GPA, had the MCAT scheduled. But what people don't know is during my time as a student, to focus on studies, I went and sold security systems door to door. So in between each of my classes, from freshman to sophomore, every summer, I'd go out and sell door to door because the goal was I just need to make enough money to live as a college student so that I could focus on studies and not have to work during the year. And so my first year doing sales made 60 grand. As a college student, that's plenty money, that paid for
yeah.
school, everything. Second year, 75 grand. My third year, this was my year between my junior and senior year, I made 100 grand. And this, mind you, this is in a summer, right? And so I sit down and I remember telling my dad, he's like, hey, how much you raise? I was like, 100 grand. He was like,
Huh?
what are you doing? He was like, yeah. He was like, son, I don't think you understand. Like, what you don't you don't become a doctor to make money, right? Relative to what the world tells you and what doctors are making, that's really not the purpose, right? He's like, if you're making that type of money, we should really reconsider your path, right? And so that was to your question, Cameron, that was it, right? That was the question that changed everything. Was like my dad asking me like, "Hey, why are you on this path?" Right? And so and luckily school had credits have a lifespan, so I knew if I quit, if I went all in and did sales and did work out, I could I could burn 2 or 3 years and afford it. I can come back and pick up where I left off, right?
Yeah.
And so that's what I did. But I jumped all into sales, moved to Houston, moved my young family out there. We got married, went out there, didn't know anybody. And the first year I quit and left school, that was the first year I made multiple six figures. So in that full time, I made just over 200 grand, which is my first year doing it full time. And so that was kind of the start of the entrepreneurial dream. But I always have to give that context because it's important, right? Like my heritage, everything where I come from was super valuable to kind of get us to this point of me jumping in and being an entrepreneur full time, right? So
Well, did you ever go back to school?
I did. So I went back to school just to say that I could do it, and I took 8 credits, and I lasted 2 weeks. And it was like, I was like, this is a waste of
So you
time.
can't.
This is a
So you
freaking
can't
waste
do
of
it,
time.
Lamè. Is that-
I can't do it. I was like, by that time, I was like, this is a giant waste of time. I don't know why I'm
Yeah,
here.
no,
And
totally agree.
oh man, and so but I tried, and you know, so but it's just funny the perspective you have about education once you've kind of went through the school of hard knocks.
Yeah. Right.
It's like I think a lot of people, if they ask themselves why they were there at school, if any of that motivation is money, I think they do not realize the opportunities that the school of hard knocks will give you, right? How easy it is to make money outside of formal education, right? In fact, it's a preferred method, but you don't know what you don't know, right? And if everybody knew that, not everybody would be entrepreneurs. Everybody would be entrepreneurs. It wouldn't be as valuable. So I'm thankful for that unique perspective. So
Well, so how did you get from there into the short-term rental space?
really good question. So I kind of context where the business is today. I obviously own an investment company, Elk Ridge Investments. We specialize in short-term rentals, have over 300 properties. We're in 14 different states. It's funny because I never envisioned myself in real estate ever. It kind of just fell upon me. And frankly, there's been a kind of a hockey stick effect, right? Like a lot of my success has been seen in the last really 5 years. And one of the questions I get asked all the time, right, is, Mama, how'd you build such an empire in 5 years? And my response to them is, I didn't do it in five. I really did it in 12, right? Because I started this business really without knowing it when I started door to door, when I started sales, when I started learning those skills that I didn't know later in life would be extremely valuable. I kind of coming back to the story and picking up the timeline, right? I left, started door to door, had a great career in it. I learned a lot of valuable lessons, right? Very few opportunities can you learn life skills where you knock on somebody's door, they're irate, they hate you, they don't even know you, they don't know what you're selling, they want nothing to do with you. 30 minutes later, I'm walking out that door, signed PSA, cold Coke in hand, and he wants me to marry his daughter, right? The life skills that
That's
happen.
the skill there, man.
Exactly. Right. And the life skills of like emotional intelligence, negotiations, persuasion, communication, right? Those life skills are the most valuable in any capacity because you're communicating, you're selling at all facets of life, right? In anything that you're doing. And what I didn't realize is back then, those would serve to be very valuable once I turned on the gas and realized I wanted to be in real estate. How it came about specifically was I bought, this was back in 2017, bought a primary residence. We lived in it for a year. My wife wanted to move back to Utah. This was in Texas. We lived in Houston at the time. My wife wanted to move back to Houston or back to Utah from Houston, and I was too lazy to move furniture. I was like, babe, there's no way in hell I'm going to put furniture in the U-Haul and we're going to drive that and go. Like, let's leave it here and we'll buy new furniture. And I was like, you know what? And like, let's just try out this Airbnb thing. And my goal at the time was just to break even on the mortgage. I was just told my expectations were low. I was like, if I can just,
Mhm.
even if I could just mitigate it to like three figures, if all I can do is float a mortgage 3 figures, I'm fine. We can live with that. First year or first month of it doing it, after expenses, everything, we made 2 grand. And that was back then. I look back now and I realize it was a product of the market, right? Like it was good then. You could make a bet on bricks because that listing, and I still have pictures of it archived just because it's like the come up. Because I look at it now and I'm like, that is such a garbage listing. Like that is terrible. Like what was I thinking? But That's because I didn't know what I knew now, right? But that was how I got in, was because and I operated that for about a year, 2 years, and started a management company because I was like, I know this, and it was all pretty passive, honestly. Like I was just kind of like dealing with the cards that were in front of me, and I had this house that was teaching me Airbnb by way of me just trying to figure out my mortgage. And then I was like, hey, I like everybody else, you kind of have that decision where you're like, can I do more? What else can I do? What side hustle can I pick up? Started a management company, and then that's when it kind of grew from there, right? And so, but I think there's a lot of life lessons in that, in the sense that, like, sometimes you got to play the game in front of you with the skills that you have at the time. And usually when you just put one step in front of the other, you look up and you've come, it's been a journey, right? And that's what it's felt like with Elk Ridge. So
Well, with Elk Ridge, Lamè, what would you say is the main problem that they solve?
with Elk Ridge, we and I think understanding context of background to where we are today, like that the problem we've solved has changed over time in a lot of different ways, right? The first problem we were solving was operations. People did not know how to operate a short-term rental effectively, nor did they have the time. So we got really good there on the management side, everything like that. We went deep. So my background is in operations of STRs. And then we started to see that there was a shift in the market where there was an opportunity to buy deals creatively, right? You guys know Pace Morby, Chris Prefontaine, these are some big names
Yeah.
in the space.
Yeah.
There's a huge opportunity when interest rates are high and fears high to go and to create deals creatively. So we started to buy properties in a form of, essentially playing the long-term game of equity and solving for investors that wanted to be non-passive, right? Or non-active, right? And so that's when we kind of opened up our acquisition arm, to where today, in doing that and building those arms, and we've taken all of our experience in solving those problems to solve this problem. We help a lot of people take advantage, specifically high income W 2 earners or high tax liability business owners, take advantage of a very unique STR tax code of being able to depreciate their active income with active losses of a short term rental, right? AKA depreciation. And so today, that is the problem that we solve very, 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 very well and very uniquely, is that we can help people solve their tax liability by way of participating in short term rentals. And oftentimes, when we look at the numbers, the savings at which we can create for them, especially for W 2 guys, is often what they're saving is often, about the same or sometimes more than the initial investment of what it takes to participate. And so it ends up being a no-brainer. It's like I kind of go to people, I'm like, hey, you want to give your money to Uncle Sam, or you want to give it to Uncle Lamè? You pick, right? But the only difference is Uncle Lamè is there to help you, and I'm a partner with you. We'll take care of this. So that's what Elk Ridge Investment does today, and that's the problem that we uniquely have built a business around to solve for.
Love it. There's a couple things to unpack there, if you don't mind. You're kind of jumping around. What kind of real estate are you guys focus on, and what makes it different from kind of like a typical turnkey or a syndication model?
Really good question. So the structure of these are surrounded around the short-term rental tax loophole, right? And it's a legal loophole. In the short-term rental tax code, in the tax code, there's a segment where if you own a short-term rental and they check these boxes, then you can take advantage of significant tax benefits, right? And so specifically, we are buying properties that are short-term rentals. We're underwriting them as such. But part of how we acquire is what our secret sauce is because we're combining this world of creative finance, where, for example, our blended rate of our portfolio of 300 plus doors in 14 different states is under 4%. And then on top of that, like, let's take today's market. In the last 6 months, we've bought about 20-ish doors. Our blended rate on that portfolio is about 4.2%. So we're creatively acquiring properties with significantly lower interest rate debt than traditional mortgages, which then allows us to be able to turn it into a short-term rental that produces and yields much more cash flow than a traditional investment, right? And so our secret sauce is we can buy those. We know how to find them. We know how to negotiate them. We know how to find them. But the deal is the first step. The second is then knowing how to operate it very well, right? And that's where the collective experience of how the company started and where it's landed comes into play for us to serve as a very valuable partner for anybody. Is we know how to buy very, very well, and then in effect operate very, very well to be able to allow us to to be able to take the benefits from it, right? And because of the short-term rental tax loophole code, if you can check these three boxes, which we do, then it automatically allows this individual, our capital investors, our capital partner, to be able to participate in the tax benefit, which is significant, being able to offset their income. So that's structurally what the deal looks like. These aren't syndications to where it's a group of people and everybody's slice of the pie is the same. It's actually a very intimate deal by deal because we are partners in this deal. There are some things that you need to participate in to make sure you can take the appreciation or the depreciation of the asset. But by way of that, because it's not a syndication or fund, we don't have to be held to some of those rules. We can be very flexible to serve you really, really well, right? So anybody that's coming to us, it's not a pool of money. You're actually selecting from a handful of opportunities that we have. And when you select that opportunity, it's just me and you. There's nobody, there's not a group of people, it's just us. And we're just operating that very specific asset in a very effective way.
Lamè, you want to maybe walk us through like an example or a case study?
Yeah, absolutely. I actually have a deal here in my back pocket. And I can show you. I don't know if you can. There we go.
There we go.
So this is an actual deal. At the top here, you can see that we kind of showcase the total potential ROI on the property. And this is a property that we have right now in Hollywood, Florida. It's a beautiful property. We are going to be able to turn a lot of this into an even better qualifying asset just by way of, because some people look at this and if they don't know short-term rentals, they're looking at this and they're like, oh, that's gorgeous, that's beautiful, and it's like, yeah, it is, but there's also a lot of things that we can do, right? The highlight of this deal obviously is how we're purchasing it, right? So we're purchasing it at market, but the thing that is unique is that the interest rate on this property is significantly lower. It's about a full point or more lower than market rate today. If I'm buying a property as a, for example, on a DSCR, no, I think DSCRs right now are 7.5. So it's almost 2 points below market right now. We have solid PITI, but we've underwritten it, and we really, the comps on this property is it should be doing gross about $8,000 a month, right? And that's what we showcase in our purchase terms of why we're so good at the acquisition side, because relative to what we can essentially allow it to cash flow, it's gonna yield very well when it's all said and done, which allows us to give our investors really these investment terms, right? And by the way, this is an active deal. We have a handful of people that are shopping this, but this is something that we can move today if it's something you guys want to be a part of. But more than anything, these are the type of deals that we're moving weekly, right? And the benefit for an investor is they put in 200 grand, they get a fixed distribution of 8% a year that is paid monthly. And so they're getting a monthly distribution that they're seeing, it's consistent, it doesn't change based on the performance of the portfolio. These are standardized fixed distributions. And we've done that because anybody that's in the short-term rental game knows that the con to the short-term rental game is often the seasonality of it. It's not a fixed monthly income like a long-term renter is. It's up and down. And in a lot of markets like Florida, when you're in the winter, you're eating rocks, right? And so what we've done is because we have such a wide portfolio, we actually can essentially fix distributions because we have properties that are doing well during winter season that are it's ski time in Utah that maybe in Florida they're not doing super well, and that's why we can offset these distributions, right? The investor gets equity at liquidity, and this is the additional equity in the property that they're seeing after they've gotten a full return of their initial investment. They get 7 years to get that full return. And then this is the big thing right here that a lot of people come to us for is the depreciation. So this right here is the estimated, and mind you, 99% of our cost segs have come back over our estimates. We try to be very conservative in nature, but this is essentially half of the cost seg that is available to an investor. So when they're investing 200 grand, they can offset 100 grand of their active income year one. And so this saves them, this gives the real dollar value, assuming that they're in the highest tax bracket, of 40 grand. But if you're somebody that's a W-2 earner, a lot of that is going to be seen also in a check, right? Because in W-2s, they're withholding. And so when you depreciate your income, you get paid back all of that withheld income, right? Based on what they were assuming your AGI would be, right? And mind you, because this is not a syndication, we can move the needle on any of these. So oftentimes, like we'll have an investor come in and they're very cost seg conscious, meaning they're tax conscious. And mind you, this is only half of the cost segregation. So I can legitimately say, okay, I'll actually give you the full. And the full actually ends up being $212,000 that they can depreciate against their active income year one. And my only ask is it needs to make sense for us. If we're giving you 100% of this, then typically we'll take this down to 4%, right, on the preferred return so that it's just a game of give and take. And that's really what this is for me, because these are individual deals, I can really be flexible with whoever I need to be to make sure that I'm serving them well. And then right here, it kind of gives the return on investment. So this is essentially your ROI at the end of it. Your initial investment of 200, the total distributions, you're going to make about 100 grand in interest payments, which is seen in the fixed distributions of the 8%. You're getting your full return of initial investment given back to you, returned. And then this is the estimated equity at the end of it, which is that 20% above the appreciable equity. Now, this is based off of half of the market. And so these are very conservative in nature as well. And so I like to think that we can over deliver on these terms. And then this is kind of just giving you an idea of our proven track record. This is our team, and then additional pictures of the property. Mind you, this is before pictures, after pictures. Like this is our portfolio. Hopefully I can pull it up. This is our actual portfolio. This is the finished product of our portfolio, right? So you can see we have properties in here that we're really going above and beyond. So when you're comparing something like this, people are often looking at this and it's like, okay, that's good. But our goal is to turn it into this, right? This is our finished product of our properties, right? And so, but in a nutshell, that's it. That's what we do. That's how we do it. And that's sorry, I don't know if you guys have any questions on that. I can continue to share, but
Oh, of course. I got some questions, my friend. So let's what I'm hearing is that one of the advantages is that depreciation. And
correct.
as a lot of our clients, sometimes they learn the hard way because there's such great tax advantages of real estate. They get in the real estate game, but then they learn about the difference between passive losses and active losses, and they're not able typically to deduct passive losses. And by default, real estate is considered passive. Now, they've made some exceptions, like with the short-term rental, but it was minor because I know some people that got into maybe a syndication of a short-term rental. They were very passive investors, but they didn't meet the active requirements of the IRS. So even though they were in a short-term rental, they weren't able to deduct or take those advantages. How are you able to allow them to take those deductions?
Great question. So I'm going to preface this question first with disclaimer, right? I am not a CPA, and this is not CPA advice. However, I have CPA counsel, and my advisement would always be to double check everything with your own CPA. And we do work with, that's our primary client facilitator is, tax professionals. With that being said, there's a few things in the code that people often misunderstand. And a lot of it comes down to just structure, right? When you're in a syndication or a fund, you automatically are a limited partner. You're an LP, as they like to call it. And automatically having you categorized as an LP puts limitations as to what you can and can't do. LPs cannot take active depreciation against their active income. They also can't take active losses because it's not an inactive activity. Once they're an LP, they no longer can take any of these benefits that we're talking about, right? The structure of our deals, to be more specific, and the reason why these are deal by deals is because these are true joint ventures, right? I am essentially partnering with our clients to come in on this very specific deal. But it doesn't end there, right? Because now that we're partners, there still needs to be participation outlined and criteria of the asset outlined that needs to be met in the IRS code. A lot of my job as the partner, the operation partner, is making sure that the asset fits certain criteria. Mainly, it's viewed as it's rented as an operated short-term rental. There's services that create that as such, and then on top of it, the average stay is 7 days or less, and then there's a limitation of personal use. Those are all things that we do on our end, right? Now, a capital partner coming in, my partner who's bringing the money, they also need to participate. And there's 7 material participation tests that they can do. And all they need to do is they need to qualify for one of them. And sometimes there are people that walk in that actually like qualify based on them being active in some other capacity. But for the most part, the easiest and low hanging fruit that we allow our investors to take a part in is that they need to participate 100 hours in active participation in that property or on that property, and it needs to be 100 hours above anybody else that participates in it. My job and my side as an operator is we actually will not participate above 100 hours. And a lot of people, there's a boogeyman in this space, an assumption more or less of people thinking that a management company is operating easily over 100 hours. Sure, that is the case. If you don't have SOPs, if you don't have AI automations, because material participation is me as a physical person doing a task that pertains to the property, right? And so if I have cleaners that are going on, that is a physical act, right? If I have maintenance, that is a physical act. Those are the two criterias that take up the most amount of material participation. Everything outside of that, I have a VA that's overlooking a lot of our automations, right? Very seldom are you actually talking to a real person when you're communicating, guest communication, all those other things, right? And then our whole back end. And so as a manager, we stay well under that threshold. And if we don't, we'll actually let the investor know so that they can go and participate above and beyond. But what the investor needs to do then at that point is participate in 100 hours based off of a number of different activities that we actually will give them, right? And so there's a lot of things such as, guest guidebook is a really easy one. A lot of you guys have been in an Airbnb. On the coffee table, there's it's like a 500 thick book, right? That sits, you flip through it, has a bunch of market research. You can participate that way very easily. And frankly, there's a lot of people I know that it takes them 200 hours to create that thing, right? And it's continuous, it's ongoing. You can continue to update it every other month, right? And so that's an easy way. But then outside of that, making sure that our investors can go to their property and participate in a number of maintenance issues that we can give and provide them, right? Painting, outlets, bulbs, right? There's so many maintenance things that can be done for a property to be well maintained, especially at the highest level of quality, that I can always pull back on my maintenance team to make sure that they're filling in, right? And so there's a lot of things that we can do, but to answer your question, and sorry, that may have been a deeper answer than you than you wanted, Anthony, but that's it in a nutshell. I just wanted to make sure there was no room for error, right? So
Well, that's great. I tell you, Lamè, you don't want me doing any maintenance on property. Okay, that's for sure.
yeah,
But
yeah.
doing a guidebook or a guest book is something that I could do. So you found a way to ensure that we can document it, so we can be active, so we can take that depreciation. Now, I know we're talking about the first year. What about depreciation ongoing?
Really good question. And so these criterias of checkboxes that we need to be met, the material participation 100 hours, they only need to be qualified and participated in the year at which you take benefit, right?
Okay.
Most of our clients are coming and they're taking the benefit year one. And so the beauty about this model is that you're not committing to 100 hours every year as long as you have the property. You're really only committing to 100 hours of the year you take the benefit. And frankly, a lot of our clients are buying Q3, Q4 because we're all human and everybody procrastinates taxes, right? That's the
Yeah.
biggest time of year
Yeah.
for us. When you're in that, it's a fiscal year. So really, it's really a 6 month stretch. You just have to figure out how to get 100 hours in that 6 month stretch, and then you're done, right? Now, if you make more money next year, that then is where, you come back to, Uncle Lamè and you say, hey, I made even more money. Can I buy another property? Right. And so the solution for ongoing would be to continue to participate in real estate. But as far as like, your benefit of that year, that's the only time you'll need to effectively need to take that, like do those items to be able to take the benefit of that year. And then anything after that, it doesn't even actually need to be a short-term rental at that point. It could be flipped into a long-term.
But I got a question on you mentioned a partner, so I assume the investor is partnering with you.
Correct.
Is there a possibility of having multiple investors kind of partnering up and then partnering with you?
No, not with what we're trying to do now. So I'll give you this. So there's a yes and no answer to this question. When I am partnering with an individual or individuals, on paper, I am partnering typically with my entity and a single entity, right? That's how it always needs to be written up in terms of our mine and a capital partners. Now, if that entity on the other side is a father and a son, for example, they can do that, right? And so you can pull together money with another partner, but it would need to be done on the side of the investor, on their side, not
Right.
ours, right? And then from there, they can essentially get a K1 and distribute amongst them. We'll give them a K1, and then they can just divvy that out amongst them. But that's how it needs to operate. So yes and no. We do work with multiple people. It would just need to be, within a single organization or entity that is doing business with us. So
And then on the creative side, you mentioned that, or I guess my question is, does somebody come to you with just a dollar amount and say, "Hey, I've got 200,000 I want to invest," and then you just go find a property? And then is it safe
that's
to assume? Is it safe to assume that it's still kind of that 20% rules when you're looking for properties that, hey, the down payment is going to be whatever you come to the table with?
that's often the case, right? Oftentimes people are coming with us, and my first question really is twofold. First one is, how liquid are you? And then the second is, what is in order, what do you rank in order the benefits you're seeking? Tax, equity, cash flow, right? And based on those two questions, I usually can help put together a deal that serves them well, right? But most of the time, people are coming with us like, "Hey, I have this amount of money. These are what I'm trying to get out of it," and we go from there. We have these deals that that we're constantly sending out to our partners, just because I have a lot of people that will just purchase repeat every year before the end of the year. But for new people, it's often a time of us getting to know each other, develop a relationship to be able to figure out what are your needs and how can I serve you. Because really, our standards are the 8% and the equity. Those are kind of set. Those can change. However, they're going to change according to whatever makes sense and what other levers are being pulled. The depreciation is often the one that is a variable that isn't fixed, right? And that's because sometimes I can buy a property that's $1 million, and all in, me buying the property, renovating, updating it, it's only 20%, as opposed to maybe I have another one, the same $1 million, but it's 25% all in, right? And so that's where the depreciable basis can change depending on the asset. But for the most part, we're trying to keep most properties in that 20 to 25% all in, which typically keeps the depreciation relatively competitive to their dollar spend. To whatever they're giving me, I can usually give them at most a dollar or a dollar and a half of tax benefit for every dollar invested. And usually most of our deals will yield that, give or take.
Now, I'm sure you're based on this. I'm sure you're following the tax code very closely, and there is this big, beautiful bill that is going to increase that first year depreciation. The numbers you shared with that, is that based on this bill passing or was currently on the books?
Really good question. So we are very close to this, in terms of this bill and everything like that. And kind of to speak to that, there's three things that need to happen for a bill to pass. Needs to go through House, needs to go through Senate, needs to go through the president. The House passed it with 100% depreciation. They brought it back. The Senate just came out recently with an amendment where they actually made it permanent. That was the only change, right? And
Permanent?
obviously, they want to make it permanent. That was the adjustment that they had in the big beautiful bill. That was the only adjustment they had. President obviously is a real estate guy. He's going to want it passed. If depreciation was its own bill, it would have passed, right? And so, and again, I obviously we won't know until it's done, but I will bet a lot of money that it is going to get passed. If this wasn't one big beautiful bill and the AI memorandum and energy tax credits weren't considered in this bill, it would have already been passed. I really believe that. And so the amendments that are being adjusted and up for negotiation are all really focused around those two things, AI and then the energy. Those are the two most controversial within this bill, right? And so I have full confidence that it's going to come back, and because of that, a lot of a lot what we're essentially forecasting, which is important to call out, is that it does come back. But this is fresh off the past press today. The White House just announced that President Trump actually just canceled all of his travel plans for this weekend to work to get the bill to pass before July 4th. And so that's on the books. And so again, that's my professional opinion as somebody that's
Yeah.
in the space. So I'm talking to CPAs constantly and looking at where the patterns are, and I believe it's going to be back.
But in summary, if this bill gets passed or something similar, I do think they'll get this depreciation bill passed in one way or the other. But if that does pass, that's only going to increase the advantages of what you're doing. Is that correct?
Exactly. Yep. Not
Okay.
only increase it, but also, based on how it's written now, it changes it forever. It honestly
Yeah.
changes the real estate game for the normal day consumer, which is why I think they want to pass it on both sides of the aisle, right? Because I don't
Yeah.
think anybody wants Blackstone coming in and making all of this corporate, making all residential houses corporate. And so this
No.
depreciation bonus, it benefits the middleman, right?
Now, just one little clarification. I want people to realize this depreciation, it's sexy in my eyes, like being able to do this depreciation. But when you do sell it, there is depreciation recapture, right? But
Correct.
that is going to be at a lower rate. And then you also have the option of doing a 1031 or rolling it over. But I just want to clarify there is that depreciation recapture. Now, you had mentioned the mortgages or the portfolio that you recently bought at an average mortgage rate of, I think, in the fours, which that itself is a huge advantage. But also, do you know what the average time those mortgages have been in place? Like, are you buying them after the first year, or are they 5 years in the mortgage?
Most of them are 5 plus. So and so I'd say the majority of them are probably within 5 to 10, which is a beautiful thing for equity, right? Because as we all know, when
Mm-hmm.
you're in a loan 5 to 10 years, you're paying more principal than significantly less interest and more principal further into the loan, which is a huge benefit as well. Which, mind you, a lot of our like kind of the sheet I went over today, a lot of our conservative estimates actually don't include that number, that value of principal pay down. We're just taking a normal AM as if we started it from day one and doing the
Oh,
math backwards.
interesting.
So
Okay.
so there's a
Okay.
there's a and there's a lot of little things like that that we're not accounting for, right? We're accounting for half of the market on the appreciation. Literally, the market needs to do literally half of what it's done the last 30 years for every property we're in. And then on
Mhm.
top of that, we're not accounting for principal pay down. So that number value that we give to still reach a 90% ROI is based off of these things not being included, to your point. So
Now, I can imagine there's some people on here that are getting excited about potentially these tax savings and getting some passive income. But who would you say that this is not for?
really good question. This is not for the people that are wanting to participate in real estate as their primary profession, right? And what I mean by that is, like, we serve people really well that are making a crap ton of money and are good at what they do, and their most valuable asset is their time, right? That is who we serve. Now, granted, we're going to ask for a little bit of that time, but the ROI for that time is going to make a lot of sense, right? But for the person that approaches us, that's like, well, I want to own all the asset. I want to do all this myself. I want to do all that. My response to them is, yeah, we aren't a good fit, but we will be in 5 years. Call me then, right? And that's after they figure out what it takes. That's after they figure out the time cost. And
Yeah.
that's after, frankly, their time becomes more valuable, right? And so that is who we serve really well, is the people that are doing extremely well in their professions and they just are looking to save costs, save time. And then the people that are looking to get into this as an investor, as an active participant, they want to own all of it. That we just we're not that, right? And so oftentimes our best, most ideal, because I get a lot of people that'll look at our deals that are real estate investors and they're like, this is, you know, it tells me a lot about where they're at. Because if they're telling me like, hey, you're taking way too much equity, this, that, the other, then chances are they probably have a few long-term rentals, which is awesome, but they're not offsetting any income from that, right? But oftentimes I'll get investors that are real estate active investors, and they look at it and they realize right away like our value proposition, right? Because they understand what it takes to operate a short-term rental. One
Yeah.
short-term rental is a full-time job, right? They understand the value of their own time. They understand that, if you're wanting to build a big portfolio, this is probably the best way to do it without it sucking all of your time and without you having to build a business around it, right? And so, while taking all the benefits of ownership, that's really what the middle niche that we serve. And so that's who we serve really well, and that's who we don't serve really well. So,
Lamè, I got a question for you. Do your investors have to be accredited? And if so,
no,
what's a minimum or a dollar amount that they should be considering when they
so
approach you?
really good question. So because these are joint ventures, there actually isn't a qualification of accredited. With that being said, we always prefer them to be, and mostly because of the dollar size, right? So our average check size is typically around 100 to 300 grand. That's like our average check size where we can be dangerous. We can take a minimum of 50, but 100 to 300 is typically where we land. And usually, again, if we're dealing with people that have high tax liability, they're often more often than not accredited naturally. But
Yeah, understood. All right.
All right. So, if someone's listening right now and is interested to learn more, what's the best next step for them?
so their next best step are the easiest ways to get a hold of us of our website. And I don't if you guys want me to drop a link, I'm happy to, or reaching out to me directly on my Instagram. And so our website, you can find it at elkridgeinvestments.com. And that's our website where you can kind of book a consult. We also have a journey of a data room that I can share as well. But then on top of all of that is just my Instagram, and that's mine directly. That's just my name. You can find me by my name. Lamè, spelled like lame, last name Kinikini. So those are gonna be the two best
You
ways
know
to
what?
get a hold of us.
Another great way to learn more and be able to ask you questions with no obligation or commitment. We will be doing a webinar. We haven't finalized the date, but we're looking somewhere. Well, maybe we have, but I don't want to announce it yet. But be on the lookout. We will be putting some webinars where you could learn a little bit more here, dive a little deeper into the deal. And the best part is you have that ability to ask questions. So, man, I enjoyed this. I was looking forward to it and appreciate your expertise.
Thank you guys for having me. I really appreciate the time, and hopefully at least a half of what I said made sense. But I genuinely appreciate you guys and what you're doing, and I think it's important to have these types of platforms to talk about these types of strategies, whether it be the infinite banking method or whether it be short-term rental tax loophole. The truth of the matter is this stuff isn't found in common education, right? It's not taught in schools. It's not taught in most of the education lines that we have today. So being a part of these groups, I don't think people realize how valuable what you guys are doing is. It really is for not only your future state, but your future posterity, for building generational wealth. It's not going to be found in education. It's going to be found here in these rooms. So thank you guys for having me.
Well said,
See you,
Lamè.
brother.
Yeah, thanks for being on.
Go make it a fantastic day.
Take care.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.